Okay, so let's do a little recap and then let's take a look at an example. So we said that the capital stock in every country is just a linear function of the amount of investment there is times how productive your country is. So countries that are very productive, that have this pie being really high, are going to have tons of capital. Now, if there is no bubble, or you don't buy bubbles, then you just put your savings, your wages, into investing, and each unit of investment is going to cost you the price of capital. In the future, you're going to be able to take that capital you produce and sell it at QT plus 1, which is equal to the interest rate, and consume that. So, given that RT plus 1 is the same for every country, productive countries which have a very high capital levels are going to be able to consume more in the future if we don't see bubbles. And then we would just see a return that is, depends on the growth rate of the world economy, but also depends linearly on productivity. So if a country is more productive, it obviously has a higher rate of return. Where does this growth rate of the world come from? Well, it comes from it's just basically a function of the average world productivity. Think of this pi tj as just the average productivity in the world, and you save that amount of the productivity, but there's some diminishing return. So that's what feeds back into the growth of the world economy. But now imagine that there are bubbles, that your country is able to buy bubbles, then you can divert savings into buying the actual bubble. Each one costs 1 unit, and then in the future you can have a return of that bubble that's just equal to this growth rate. So you can consume a little extra. Now you can imagine that if you're a poor country and this is very low, you could potentially consume a lot more if you just buy the bubbles, and if this is sufficiently high, if bubbles are growing by a lot, then the returns of doing so will give you tons of extra consumption, and then the rate of return that your country will have will just be a function of how much of the two assets you bought. So think of this small b as the amount of savings that go into the bubble. So it's just the amount of bubbles you buy divided by the wage. And imagine that a country only buys bubbles. Well, then your wages only go into bubbles, and this is just going to be 0. So the rate of return of the country is just going to be the growth rate of the bubble. And interestingly enough, when this happens, this turns out to be the growth rate of the world. So your bubble is going to end up growing at the same amount as the world economy. And if the world economy is booming, then buying bubbles might be a great thing for you, because their prices are going to be going up in the stock market. Now let's think about this for a little bit. If you're a poor country, this is usually going to be less than 1/2, so you're going to be consuming less than the average of the world. So because without the bubbles, this you're less productive than the average, so you're able to produce less with the same, so you consume less. But as bubbles are introduced, you're able to gain a lot more return, and your consumption relative to the average improves. So this extra return coming from the bubble in countries that are very unproductive allows them to to consume more, and the world income distribution gets better. Now let's go over a little example. Imagine that you have two types of countries, the productive and the unproductive. They just have, pi h is the high productivity countries, and pi l is the low productivity countries. And we know, since a growth rate, the growth rate of the world is just an average of these productivities, multiplied by something and taking into account the diminishing returns. In a world where there are no bubbles, this directly feeds into the rate of return that a country can have. So it's just a linear function of its productivity. If a country is unproductive, then its rate of return is going to be lower than the one of productive countries in terms of investment. And that means that since you basically the differences in consumption patterns come from the differences in returns, we're going to have inequality in the world, and we're going to have that poor countries consume less than the average. And the reason why these countries are poor is because they're unproductive. Now imagine for a minute that bubbles start happening. Like the condition for these bubbles is that since the return of the bubbles is going to depend on the growth rate of the economy, on the world economy. If this growth rate is sufficiently high, if the world economy is booming, then these bubbles are going to be able to appear. And the threshold would be, if this growth rate of the economy is higher than, what capital gives you in terms of return in your country, then in that country, bubbles will start appearing. Now you can see why in high productivity countries this will not be the case. This would be less than that, and there will be no bubbles because they're not as attractive. But then for low productivity countries, this is actually higher. So bubbles are feasible and are more attractive than capital. So they will massively go into buying bubbles. And this is why we see that high productivity countries end up holding very little bubbles, but low productivity countries end up buying tons of bubbles. Now imagine that the fraction of the countries in the world that actually buy bubbles, starts going up. At the beginning, there's a few of them, but then there's more and more countries in the world, that think about, these low productivity countries who start buying bubbles, and this fraction increases. Now let's think about it for a minute. If we see that countries are buying bubbles, it is because the stock market value of these bubbles is increasing, and the more they buy them, the more it grows. So this booming asset prices results in fast economic growth worldwide. So the more people in the world that buy bubbles, the more the world economy grows. And the reason that Ventura gives for this to happen is that these bubbles are eliminating inefficient investment in the world. That means that low productivity countries are buying bubbles instead of producing. So this ends up raising the productivity of the capital that is actually produced only by the high productivity country. And this is why this is a more efficient situation, and the growth rate of the economy goes up. Because investment in capital takes place only in countries that are productive enough, and the rest just buys bubbles and gets a high return. And this is kind of neat because the more countries in the world that buy bubbles, this is going to feed into higher economic growth for the world. But higher growth leads to higher wages, plus higher growth leads to more returns for the bubble holder, which are the low productivity countries. So these low productivity countries are going to have a higher rate of return for their portfolios, and they're going to be able to consume more. And this higher wages and higher growth will also benefit the consumption of the high productivity countries. But since low productivity countries, the ones that are buying the bubble, benefit the most in terms of consumption, it ends up happening that world income inequality and world consumption inequality is going to go down. So the amount that low productivity countries, think of them as poor countries, consume with respect to the ones that rich countries, productive countries consume, is going to increase, and the world as a whole will be better off. And this is why financial asset bubbles might decrease inequality in the growth economy. And also, this is one of the reasons why financial asset bubbles might be beneficial for the world economy as a whole in terms of feeding back into higher growth. and higher consumption. Thanks for watching.